Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes driving markets. So those are both technical and fundamental themes driving markets at the moment. Whilst I'll just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next half an hour, 40 minutes or so. Obviously a lot still happening, a bit calmer actually out there this morning, which is quite encouraging to see really, but still a lot to talk about. We'll just generally see normal formats, actually just look at how markets are shaping up at the moment. As I say, slightly more positive this morning in equity markets, risk markets. We'll just then talk about some of the stock markets actually, and the differences between some of the outperformance in big cap tech stocks, for example, in the Nasdaq, and then in contrasting with the Russell 2000. So that's much smaller companies in the US, and that stock performance, and just a couple of thoughts about that. We'll then review the Fed decision from last week. And we'll also look at quite a good chart that we have just on where potentially rate cuts may happen. Obviously, they've been priced in a lot very recently, in contrast to what Fed Chair Powell said actually last week. So that is interesting for sure, and some volatility probably to be expected going forward with that difference there, whether that narrows or not. And we'll touch upon that, as I say, as well as then the Bank of England decision last week as well, another hike by them. And we'll look at cable then as well, so that's sterling against the dollar. Before then, just touching on a couple of events for this week, mainly inflation figures actually out of Eurozone and the core PCE data out of the US, both on Friday, those data points. And we'll just touch upon those, couple of charts to show you, and look at euro dollar amongst that, as well as hopefully touching on gold if we have time. Okay, normally start off with this chart, a couple of charts, bar charts, year-to-date FX performance. Not a lot of change on the sort of the losers at the moment, if you like, mainly commodity dollar currencies. I've called them cyclical risk, commodity dollar currencies. So Aussie dollar, Kiwi, left-hand side is last week, right-hand side a few minutes ago. But you can see still European currencies really coming to the fore, really. So sterling, Swiss, obviously euro as well. They've still got work to do potentially. The markets think sterling, Bank of England, probably another 25 basis point hike potentially. Not sure that many economists think that, but the markets do. And then you have the euro and Swissy, obviously this SNB, actually Swiss National Bank. They copied the ECB hiking rates last week by 50 basis points, supporting the Swiss dollar, Swiss franc even, sorry, and then obviously euro has got a little bit of a bid as we get these interest rate differentials really potentially. So the difference between obviously the Fed or the market thinking the Fed will pause really, maybe one more hike, whereas the euro, the ECB anyway, probably has a lot more work to do potentially, and we'll touch upon that shortly. Generally, their markets this morning, fairly decent. Asian equities kind of didn't have that much of a clear directional trend, really. But European markets doing better bid, and US futures as well are indicating a positive start, around up over 0.5% or so, I think, just looking at futures there. We did have, interestingly, a Fed speaker over the weekend, Kashkari. He's normally one of the most hawkish voices at the central bank, and he indicated actually that the recent stress might raise the risk of US recession. Even so, US yields probably the big thing that we've been looking at recently. Hopefully, or maybe you have too, but just on some of those sort of US Treasury yields, so the 2-year US Treasury yield being a big gauge for sort of market stress, and then market calm, if you like. And at the moment, those US Treasury yields, in fact, I'll just show you a chart of them. You bear with me 1 second. Sorry about that. Yeah, so US 2-year yield. This is the chart. And you can see just this volatility. We've shown you this over the last week or so, complete collapse from above 5% in this US 2-year yield to around 4%, struggling to get above there at the moment. This black line, the 200-day moving average, bang on pretty much 4% as well. And you can see just drawing that dotted line across was a big level of support before. So probably then support turns resistance, so that may be a struggle to get through. And you can just see, as I said, that volatility over the last week or so, last couple of weeks, just back and forth. A really good gauge there you can see on Friday, where we sort of plunged to new lows just above 3.5%. But that was on the back of pretty much the Deutsche Bank stories. Not sure if you heard about those, but there was potential issue with them redeeming a bond, I think it was, and markets got spooked really that this was the start of a sort of bigger issues, if you like, Credit Suisse issues potentially. But that hasn't really kicked in, and we've seen this bid in stocks. So bonds have been sold, so that means yields have gone up, which is positive at the moment. Generally then, well, after last week's Fed hike, especially, interestingly, both the US Treasury and the Fed kind of failed to offer sort of clear enough communication about a fix to the banking crisis. And it really left sort of rate expectations, by extension, the dollar really kind of strictly tied to the US financial stress. Still want to talk about that. Just the implications of the recent turmoil will take quite a time really to sort through, and especially the risk that sort of tighter credit conditions then slow economic growth. And we've said that before, actually, over the last few weeks, really, banks will probably turn more now risk averse about who they lend to, how much they lend, at what rates, for how long. And that really then hampers kind of credit flows. It weighs on the economy and allows inflation actually to fall more quickly, actually. And then you also have on the other side regulators. They're probably sensing a need to be more proactive, and that could make as well then banks tighten lending standards, as I've said, even more. I think we need to bear that in mind, because I'll just go on to sort of the stock performance and how that's sort of stood up really well, but we can't forget actually the implications for us anyway that we think could hamper the economic growth going forward. Of course, in amongst this, there's been, as I've just showed you with this 2-year yield, an enormous really reset lower of the central bank expectations for the Fed at least. And we'll just go into those sort of expectations when we look at the Fed, just on the CME Fed Watch tool that hopefully, again, we always look at generally around the Fed meetings for market expectations. They are driving the dollar, as we've said, and then other markets as well. Just on equities then, I've said sort of futures looking okay this morning, pretty good, but we are stuck around this 4,000 level on the S&P 500. But interestingly, we are flat on the month now in that blue chip benchmark index on the US, in the US even. As I said, it's kind of really interesting that we've sort of had this chaos in the banking sector, potentially wider implications, but then we've also had these historic swings in bond markets. But then you look at Wall Street and the crisis kind of appears to be a non-event. As I say, the S&P 500, that's pretty much flat on the month. And you kind of figure, well, you know, what's the issue? Certainly, I think market positioning is interesting to note. Equity exposure was at a kind of base level when the bank crisis began a few weeks ago. If you think about it, the S&P 500, I'll just draw up a chart here. We just look at the weekly chart, you can see sort of we were in a bear market, sort of more than 9 months or so ago, by the time we had this collapse of SVB, Silicon Valley Bank, on March 10th. So many investors had already scaled back their exposure to stocks. That therefore kind of reduced the chance of a further exodus from the market. And that's sort of something to bear in mind then as to why we've seen sort of relative strength in equities. Again, equity investors also seem to be putting in a lot of positive weight on these falling bond yields, which of course is positive for stock valuations, but you kind of have to think about why bond yields are falling, and essentially they're falling because of corporate flows going from deposits into short-term bonds. And this newer sort of lower Fed funds futures forward curve, which we'll look at shortly, that kind of reflects market expectations that a recession probabilities anyway are definitely on the rise. US leading indicators, that index is now below the level from back in late 2019, before the pandemic actually, and that was when the economy clearly was slowing down and potentially headed for a recession. As I said, it's worth looking at this sort of divergence, if you like, between some of the stock market indices. The big momentum that we've seen is in the NASDAQ 100. That has continued to new highs, just show you here. This is on the weekly chart, but you can see daily chart, we're now back at those highs from year-to-date highs. You can see last week, actually, we broke to new ones, just couldn't quite close at those. But the 2nd of February high was 12,880, actually. You can see we just touched above that a couple of times last Wednesday, the new high 12,943. But we're up 17% this quarter. I think that's the main probably key figure to think about for the NASDAQ 100, up 17%, so nearly 20% on the quarter. Contrasting that with the KBW, the bank index, that's shed 22% this quarter. So of course, lower yields increase the relative appeal of long-term corporate earnings, and they also provide a boost really to high-tech growth companies, which have, if you remember, if you know, a disproportionate impact on, for example, on the S&P. The top 10 companies there account for around a quarter of the index's value. And then if you think about the big tech companies, Apple, Microsoft, they're actually the two largest companies on the S&P 500. They've climbed 9%, 12% respectively just this month. Alphabet, that's up 17% on the month. So it's kind of, as I said, quality mega cap tech stocks with strong cash flows are being favored amid this sort of uncertainty, with companies' robust balance sheets really in focus. And that comes against sort of their outsized gains, being or sort of offsetting problems at smaller businesses. And it does mean the sort of market is, this is really a key point, actually very, very narrow, which is kind of the broader index is being held up really, while under the surface, the breadth is kind of breaking down. And a really good stat actually I read, which is that if every company had an equal weighting in the S&P 500, the index would actually be down 6% this month, and not flat as we are currently. So yeah, just a few things to bear in mind. I think, as I said, smaller company shares, they're being hit by investor concerns that problems in the banking sector would lead potentially to a credit crunch, making it harder to borrow, and then weighing on economic growth, as I've said. And the contrast with the Russell 2000, that's an index of small cap stocks in the US, that is down nearly 9% this month. So differences, as I said, between big mega cap tech stocks, definitely quality ones, and then these smaller companies and that impact on the economy, and just something to bear in mind, I think, going forward. Yeah, just technically, if we just look at some of the charts, so we've got the S&P 500. If we look at the weekly, again, really, it's all about, well, this falling trend line, sort of resistance, now potentially support again, you can see there. This is the 200-week moving average, which we touched, obviously, back in October. Didn't quite get there last week or a couple of weeks ago. That's at 37.36 now. Falling trend line support there. Around then this key level of 4,000. The light blue line is the 50-week moving average. That's just below the 4,000 level, 39.66. If we just go to the daily, then we've got sort of confluence really of indicators. That 200-day moving average, which is at 39.32 there. I've also stuck in the 100-day moving average just below 4,000, and then the 50-day moving average, that light blue line, just above 4,000. So sort of choppy price action, sort of mirrors that 2-year US Treasury yield price action as well that I showed you. But we're sticking around and above sort of that trend line resistance support, and then well, oscillating around the 200-day moving average. So interesting to see whether we did make sort of that high last week, as I said, 4,039 on the S&P 500. If we do push above that or not, or whether we're just sort of oscillating around this sort of 4,000 level. NASDAQ we've just looked at, but just to show you then, so yeah, key resistance really still that February, that previous year-to-date high, 12,880. And just interesting whether we can get above that or not. The Dow then contrasting really the sort of tech-heavy NASDAQ with the Dow. Dow's kind of struggling. You can see below actually now the 200-day moving average, that's at 32,358 there. That black line did push above that, but couldn't close above it. You can see last Wednesday, and again, sort of choppy price action, not easy to trade really, unless you're trading very much intraday really. But we need to get above last week's high at 32,761 really to push up towards these sort of simple moving averages, probably, I'd say. Just also always like to look at the DAX. Interesting. Yeah, this is the weekly DAX chart, the German index. Yeah, I think we showed you before last week. We pushed down below that sort of fib level at 14,581, but a strong close then above it at least. We pushed on this week up over 1% now this week, so encouraging. Next probably target for the bulls 15,334. That's a minor fib level you can see there of the 2022 decline. Before then we get, well, we're above 15,000, so that's important, psychological level really. But yeah, 15.3 around there, probably the next upside target before we get into these highs above 15,500 or so. FTSE, that big down week was troubling, of course. And really, you can see now choppy again, 200-day moving average 7422. May or act as support. Before then, we need to push above last week's Wednesday's high at 7585 really to get above towards a 100-day moving average. And you can see that previous weeks, a couple of weeks ago, that big red candle there, we'd probably need to get above 7689 to sort of that level there, which becomes strong resistance, I think, really before we can look at the highs again. Okay, we'll just look now at last week's main event, which was, of course, the Fed. I'll just go to CME Fed Watch tool, which we always like to look at. Just before I talk about that, yeah, so the Fed obviously delivered a 25 basis point hike, moved rates to 4.75% to 5%. I think the language was about sorry, the language about future tightening in the policy statement, which was obviously what we got at the start, was softened. So went from sort of ongoing increases in the target range to some additional policy firming. We also had, of course, updated dot plots. They suggested possibly one more 25 basis point move this year, but then that would be the end of it. And that was kind of slight contrast. I think I gave the figure sort of around the sort of 5.375 mark, which is where most economists thought the terminal rate of the dot plot would go to from 5.1% in December. They stuck it, they kept it the same at 5.1%. We had growth forecasts were revised down for this year and for next, while inflation was seen a bit higher, I think at 3.3% this year, but an unchanged 2.5% in the following year, 2024. Unemployment still expected at a low 4.5 to 4.6% across the time horizon. So that kind of suggests ongoing faith in has to be said, a very strong labour market that we're seeing, of course, now, currently. The recent banking turmoil and its effect on credit flows and consumption and demand was seen as uncertain. But Fed Chair Powell, he did say that potential pullback in lending would indeed do some of the work of monetary policy. I think he said at the moment would be equivalent to probably another 25 basis point hike. Interesting stuff. He kept the other option of still higher interest rates open in case of only a modest economic impact, and obviously given still elevated inflation and, as I've mentioned, the pretty decent, very decent shape of the labour market. But all in all, kind of seen as a more dovish tilt to the Fed, especially with those dot plots. That's the projection for interest rates going forward. But this was kind of contrasted, Powell kind of wanting to downplay the chances for rate hikes, as I said, with actually the dot plot showing none. So really interesting. We sort of went back to this situation where markets differ quite considerably from what the Fed is saying, from what Fed Chair Powell is saying. If you remember, that happened a few months ago, and then the markets came round to the Fed imploring really markets to price in higher rates at the moment, or especially after the press conference and since. Markets, completely different view to what the Fed Chair Powell was saying, turned increasingly doubtful that the Fed will be able to tighten policy any further, and pretty much simultaneously speculated on an early start to the easing cycle. You can see here, so the next meeting, 3rd of May, we can see there's only... Actually, let me just refresh this because it was around 25% chance, but the chances of a hike, have actually risen now with this positivity this morning. This SVB deal, I think it is, some of their assets being taken over by another bank. So that has, you can see, I thought it was 25%. I checked that probably an hour or so ago, I thought. But now a 35% chance of another hike, a 25 basis point hike at the May meeting. And then 65% chance that we remain where we are currently, 4.75 to 5%. Sorry, just checking the pricing here going forward. And then there's, just moving forward, just look actually. So July, you can see where we are currently, 4 3/4. Then you've got above a 50% chance of a rate cut. That's in July. And I think by the end of this year, we have around 75 basis points of easing by year end. If we could just go to the debt meeting, actually, you can see, sort of 30, obviously different percentages. You can see that from the current rate of 4.75%, which is here. Obviously, then we've got these rate cuts priced in, but a total, I think, around 75 basis points of rate cuts priced in by year end. I just want to show you this chart, actually, because there's a lot of talk around this, whether we obviously get this, first of all, importantly, whether this pricing changes, if, obviously, big if, the banking situation calms, as I said, then potentially these cuts get priced out, as we saw before over the last few weeks before the crisis, and then potentially we get sort of more of a chance of then this hike getting priced in, or even, yes, this sort of tipping from sort of 60-40 to, say, 60% chance of this hike. But obviously that's all dependent for us on a sort of calming in this banking crisis, and potentially then announcements by Treasury Secretary Yellen. I'll get to that shortly, but I just wanted to show you this one chart, which is by an investment bank, and it's basically, yeah, not looks a bit fussy, doesn't it? But it's just showing you really the time between the last hike and the first cut. You can see on this on the left-hand side, yeah, this is a number of months from, as I say, last hike to first cut, the first ease, and the average is around 3 months. That's historically, the Federal Reserve has tended to wait only 3 months between its last hike and its first cut. And it's interesting, it's only in the low inflationary environment of the last sort of 3 decades, obviously quite a long time, but the last 3 decades, the rates have tended to be left at their highs for much longer than previously, which you can see here, just this big jump over the last 30 years or so, where rates have been left higher for longer, if you like. Obviously, the difference is that none of those hiking cycles were anything like as aggressive as the current one. And I think, we'll probably get, or we are getting emphasis on this now by some economists. I think there's a difference. Some economists think it's kind of towards the sort of 6-month mark between the last hike and the first rate cut. But that, as I say, is probably skewed by these this last few cycles here. 07 after, well, GFC, 15 months it took. I haven't quite put that on there, they haven't, but sort of that average skewed by those taller bar charts over the last few cycles. But just something to, just a sort of thoughts about when hikes end and then the cuts begin. I should also say as well, just interestingly, during that press conference of Powell's, we had US Secretary Yellen. Really didn't help actually matters, and the market was sort of skewed by her comments. She pushed back against the recently floated idea of providing this blanket deposit insurance to stabilize the US financial system. She was appearing before a Senate subcommittee. Bloomberg had earlier last week reported that the US Treasury was studying ways to temporarily raise that Fed insurance cap above $250,000 if small lenders face difficulties. She then sort of pushed back against that, and markets didn't like that, in contrast to the sort of more dovish Fed. So it was quite volatile during that meeting, and certainly the markets paid sort of more attention in a way to her comments than Powell's. I think that will be important going forward. Clear communication, if you like, between the Treasury, between the Fed, even, because Powell during his press conference kind of believed that there would be some sort of deposit insurance, if you like. So that'll be interesting going forward. I think this week, whether we get comments around that, which would really be positive again for market sentiment. Especially in contrast to, say, Kashkari's comments, as I said, which sort of talked about these risks of a credit crunch hitting the economy and generating a deeper economic slump potentially. We do get more Fed speak this week, so again, listen out for those comments on the wires potentially. Okay, that's the Fed. Quite a lot of comment about that. Of course, any questions you do have, any queries, any thoughts, please do ask them away or write them in a box if you can, and we'll try and answer those along the way or definitely at the end. So otherwise, the other main important event last week was the Bank of England decision, kind of in contrast to the Fed, who kind of struggled, as I said, to convince markets that this won't be the last hike of the cycle. The Bank of England, they kind of took a middle road. So we only got the statement this time, no press conference, but it appears sort of more clear, quite clear that the MPC, the Bank of England, tried to keep options open really. It did raise the policy rate by 25 basis points, so that's to 4.25% now. Inflation in February ran higher than expected, but mainly due to what the bank considers one-off effects, and it still expects to actually ease materially in the coming months. Yet on the other side, the economy, the labour market is still proving stronger than expected. And then against this whole background, we've got the Bank of England kept further tightening conditional actually on evidence of more persistent inflation. Just about recent sort of financial system developments, the bank said it will consider its potential impact on basically credit conditions in the new forecasts that it publishes at the May meeting. So that will be, a major risk event really, and obviously dependent on what happens in the meantime with those financial, the banking crisis, if you like. Money markets, they bet, as I said, on one more 25 basis point move in the second quarter, and then start pricing in the first rate cut actually by the end of the year. Going forward then this week, today, tomorrow, we actually hear from the governor, Andrew Bailey, and definitely his words will be looked at, will be considered, weighted very carefully by markets, given that obviously last week's meeting didn't have that press conference. He speaks today. I don't think need to check the time, actually can't remember the time, but he speaks at a Bank of England event. But then tomorrow he speaks at, or he testifies actually in front of the Parliamentary Treasury Committee about the collapse of the Silicon Valley Bank. So yes, just watch out for those comments, potentially market moving. It does seem as though the bar for a hawkish surprise to lift sterling kind of seems quite high now, with especially as another we've got this one more 25 basis point hike priced in by markets. There's not very much on the data side in the UK this week, so yeah, sterling going forward impacted by Bailey's words, and then also then driven by external factors. Certainly it's a dollar story as well at the moment for cable, for sterling against the dollar, whereas say euro sterling is more of a euro story. So yeah, just technically this is the cable chart, so sterling against the dollar. Interesting. Yeah, we're kind of bullish consolidation potentially, although it is going on probably for longer than we would like, to challenge last week's high. That's at 123.43. If we can break higher above this sort of consolidation, then we will definitely look at these highs around 124. So yeah, kind of interesting. Just pull up the weekly actually. You can see that sort of, not so positive candle sort of closing nearer the lows, although still up from the previous week, but certainly definitely off that high, last week's high, as I said, 123.43. Otherwise, if we don't keep within this range, this consolidation, probably that low important at 121.78 near-term low, then we then probably move down. Test the 50-day moving average. That's the light blue line at 121.47. Oh, excuse me. or then we've got the 100-day moving average just below 121, 120.98 there. That's on cable. Okay, this week, otherwise, we have that inflation data, as I said. Just bear with me. Just pull up a chart for you. Yep. So first of all, well, Eurozone HICP, that's basically inflation data. That's expected to, well, actually, I'll just show you the headline there. You can see the orange line falling now, essentially on base effects of energy prices, whereas this darker line is the core number. So still rising, and that is the big issue for the ECB. The headline number is expected to fall to, I think, 7.3% year on year in March. That's from 8.5% in February. All down to energy, big base effects. Those are essentially comparing prices to 1 year ago. And 1 year ago now, for March, we hit the 1 year mark for the outbreak of the Ukraine war, of course. So that led to a massive surge in European prices. Now we compare prices compared to that, and we will get a big fall in the headline HICP figure. Core inflation, that dark line, as I've showed you, that's set to remain hot. Potentially slowing, I think, very slightly to 5.5% from 5.6%. And then beyond that, or this upcoming release on Friday, well, economists, I think they expect headline to continue fading, but it will be very bumpy on account of the base effects and also the withdrawal of policy measures. This upcoming release actually is the first of 2 inflation reports due before then the May 4th ECB meeting. So not really having the final say, this one, in cementing expectations for that risk event. As it stands, markets were pricing in around 50-50 for an increase at that May meeting, but I think now that's coming back towards sort of 60-40. Actually, 50-50 was sort of Friday on those Deutsche Bank issues, but now those are sort of calmed. I think we're getting stronger odds of a 25 basis point hike at that May meeting. We've also had generally quite hawkish ECB speakers, and Lagarde as well has been on the wires end of last week, actually definitely sticking to this line about this separation between financial stability on the one hand and then price stability, inflation fighting on the other. So that's Eurozone HICP inflation. If we just look at the Eurodollar chart, you can see that big sell-off on Friday, and then we sort of trying to sort of steady after that, that sort of big move down on Friday. I've sort of mentioned this monetary policy divergence between, say, the Fed, who's very close to the end. Markets think it is the end of their tightening cycle, whereas the ECB will continue to hike. Much depends, of course, on that core figure really on Friday. Certainly, it's not a straight line up, although we did have obviously how many? 1, 2, 3, 4, 5 days, straight days of gains, and then this sort of pullback. So generally, with the ECB being more hawkish than the Fed, this monetary policy divergence really, then that should probably give a bid to Eurodollar. You've got that light blue line, 50-day moving average, acted as resistance, and we broke above it. Now potentially support. That's at 107.26 in Eurodollar, but we really need to break that last week's high, 109.29. If I just pull up the weekly, then we've got, the fib level, halfway point of the 2022 decline at 109.42. So didn't quite get that last week. So that's plus that 100-week moving average, 109.70. So above that, but 109.42. And then last week's high at 109.29. Some levels for the bulls. Otherwise, that near-term support, 107.26. Then potentially, if we lose that, rolling back into this sort of range above 106. That is Eurodollar. Otherwise, we do get as well the Fed's inflation favored inflation gauge, which is core PCE, the deflator there. We should say, actually, everybody talks about it being the Fed's favored gauge. Why is that? Because it's basically a broader measure of inflationary pressures. So CPI figures, they are based on survey data from consumers instead of reports from the sort of wider business community and what they say. So CPI kind of indicates changes in it's kind of out of pocket expenditures of consumers, whereas this core PCE data really picks up on changes in prices in goods and services consumed by all, so businesses and households. So that's why it's the Fed's preferred inflation gauge, just in case you didn't know. But yes, that's expected to come in higher than expected on a month-on-month basis. Sorry, no. So just going back, actually, core CPI, that came in higher than expected on a month-on-month basis. PPI, that was cooler. But the figure on Friday, so the US core PCE, that's expected to rise 0.4% month-on-month in February. That's cooling from the 0.6% seen in January. And then the annual core PCE is seen moderating from 4.7 to sort of 4.3, 4.4%, I think. So goods prices, they continue to be the key driver of falling prices. That's basically disinflation. There's been good progress there, but the problem and the focus for the Fed is on shelter and basically other services, which remain stubbornly high, really. And that's the Fed's focus, as I say. Market implication for sure is if we get a weaker than expected print, then that would bring bond yields lower. That then boosts kind of rate sensitive, those tech stocks, if you like, and then the dollar could fall. That's if we get a weaker than expected print. DXY here, dollar indexed basically against 6 of its major peers. Euro, the biggest weighting, 56, 57% or so is the weighting in the DXY. But you can see it's kind of a mirror image flip. If you flip over euro dollar, it's similar to that chart, of course. So you get the 50-day moving average above here, acting as resistance, 103.46. And then potentially, if we do roll over, then we've got last week's low at 101.91. Before then, that major low from February, just below 101, 100.82. That is the dollar index. Okay, finally, just quickly, always like to look at gold. Yeah, gold, where are we? We are falling, of course, as bond yields rise, as well, the dollar is fairly unmoved, but it's yields which gold tracks a lot, of course, and they are rising. So gold doesn't obviously like that. It's a non-yield bearing asset, remember. So after those sort of big, let's just go to the weekly, you can see those big strong weeks that we talked about last week. Then we did push up to a new 12-month high, at least 2009. That is the price there, the high from last week. But we did close lower than the previous week. You can see there that candle. And I've just marked in the 2000 level there. Always key, always massive psychological level. Sorry, did talk about that last week when we were pushing above it. But just be very careful of that. Tried a couple of times to push above it last week. Didn't do so. And now we're rolling over and moving down actually below that February high, which is at 1959. Again, big caveat is, of course, the banking crisis, whether it calms or not. If it does, then these yields may push higher, and that is a negative for gold. I think, interestingly, on the sort of more fundamental side, if you like, we've had the March actually was the first month of net inflows into gold ETFs. So that's exchange traded funds. First month in 10 months. We've seen net inflows into gold ETFs, while interestingly, the volume of bullish options bets tied to the funds has approached record levels. Options, basically call options, they give the investor the right to buy the asset at a set price at a later date. And I think those 5-day rolling volume of call options on the gold ETF, the big one, they surged more than 5 times since the start of the month. So those are kind of professional investors, but piling in a way into some of the ETFs. But technically, we're hitting a key psychological level, that 2000, then we're rolling over. So it's interesting to see really where we go next. And much may be dependent on, obviously, the banking crisis, but then also those inflation numbers. I actually have the chart of the PCE inflation, there, and you can see it's sort of just hanging around really around that sort of 5%, just 5% level or so, just below there. Okay, that is about it for now. Hopefully you've got something out of that. A lot going on. We always say that, but really interesting times. And take care out there, and we'll speak to you, of course, next week.